this week gave us another example, yet another example, of the fact that the markets reflect part of the world, but not all of the world, leaving investors to hope that some of the problems in the real world don't spoil the party in the markets. And to talk about that party, we welcome now Mona Mahajan. She is investment strategist at Allianz. Mona, welcome to Wall Street Week. Good to have you here. Tell us about the party, and specifically, how important were those jobs numbers that we got just at the very end of this week?
Thanks so much for having me, David. Happy Friday, first of all. What a week. Look, the jobs numbers were incredible. I don't think anyone would have predicted a positive increase in employment, and yet we got plus 2.5 million versus the expectation of negative 7.5 million. Keep in mind the ADP numbers this Wednesday were also positive. They outperformed. We got plus 2 million versus an expectation of negative 7. So we had some indication of this, but clearly not to the extent that we saw today. And what's interesting is what was driving today's increase in jobs was actually the top sector to increase jobs was leisure and hospitality. And so this rotation that we've been seeing in the marketplace away from some of the COVID winners like technology and healthcare and into some of the more cyclical laggards, really, energy, industrials, parts of the financials complex, really kind of confirmed by today's news in the jobs report. And so, in our view, there's some technical factors that keep us really continuing this momentum towards the cyclical plays. Some of those factors include things like the amount of cash on the sidelines, both by institutional and retail investors, and also really the S&P itself crossing that 3,000 threshold last week. It was really a technical entry point and really a psychological entry point for many as well.
So, Mona, given what's gone on in the markets, which is truly extraordinary, where are the bargains left? I mean, are cyclicals basically fully priced at this point? Will that rotation continue, do you think?
Yeah, we think in the near term, we do continue to see the cyclicals outperform. There is some room to run when you look at the performance year to date. While they have had a tremendous about 3.5, 4 weeks now, we yet have to play catch up. The NASDAQ has hit an all-time high today. Tech is up about 8% year to date. And many of these cyclical sectors are still down 8, 15, even 20%. So we do see some catch up remaining. Of course, as we get through the next few months, we're going to be watching the mobility data, we're going to be watching the health data, and we're going to be watching the political data. I think all of those do factor in on the markets to some extent.
What about Main Street versus Wall Street, Mona? How did the small and mid caps do?
Yeah, absolutely. Look, this cyclical rally has been supportive broadly of small and mid caps versus large caps. And really, that's been the dichotomy in the marketplace. A lot of the big technology players are in the large cap space, and they happen to be COVID winners. Areas like cloud computing, cybersecurity, think about your complex around e-gaming, the video conferencing, even remote learning. Those tend to be larger, better balance sheet players. To your point about Main Street versus Wall Street, what's really interesting to point out broadly is that this crisis in particular happens to have hit really the mom and pop and really small businesses in this country. When we think about the S&P 500, for example, this is an index that has the 500 largest market cap players in the United States. They are better balance sheet players. They have more liquidity. And really, they offer exposure to some of these winners that we talk about. So when we think about our investable universe globally, really, you can see why the S&P 500 and U.S. assets generally have been this flight to safety almost play in this crisis in particular. And so that's why we're seeing a really continued momentum in the equity indices versus what we're really seeing on Main Street.
So Mona, trees don't go to the sky, in my experience. If you want to hedge a bet, where do you want to hedge?
Yeah, no, it's a great point. And, we've actually seen some of the more typical flight to safety plays like treasury bonds, like the dollar, like gold, all kind of trade sideways, even a little bit downward over this last 3 or 4 week period. What we would say is we continue to like gold here as an asset class. We think as central banks continue to lower rates and really offer more stimulus, gold tends to do well in that environment. We also continue to like parts of the investment grade market. The Fed has really come in and backstopped a lot of high quality investment grade in particular, which could be interesting here. What I'd also say is longer term, while the cyclical rally is ongoing currently, we do continue to feel like there are good secular growth themes that are not only, 1 year or 1 year horizon, but really 3, 5, 10 years out. And so when you do get those tactical opportunities to get back into some of your favorite long-term secular winners, particularly in tech or healthcare or biotech in particular, those are opportunities you should take advantage of if we see that over the next 2 or 3 quarters or so.
It's fascinating. What about value? Everybody says value is going to come back. Do you think it's coming back?
Yeah, look, value is about 25% of the S&P 500 index. And so there are a limited number of ways you can play this versus the broader index. And we're seeing a lot of crowding into the value space, which happens to be largely energy, financials, and parts of industrial. So very much overlap with this cyclical reopening story. That tends to happen, value does tend to do well as you're reemerging from a recession, which we've done over, almost in lightning speed, but we've done over this last few week period. And so I think that value play will continue to be a leader as long as the cyclical play lasts as well.